Is the infinite banking concept all about life insurance, or is the infinite banking concept about infinite banking? Let's get into that right now in a special little piece where we're going to juxtapose a few things about Nelson Nash's book, Becoming Your Own Banker, edition number 5 right here, and a life insurance contract, an illustration where we will protect the wealthy, but we're going to tell you about something we're actually doing for someone. When I was in high school, ladies and gentlemen, which was over 20 years ago now, it's hard to believe, I would read the books by going to the back of the book, right? And the back of the book is where you find the glossary of terms and the definitions. I'm going to do the same thing here for you today in Becoming Your Own Banker. So let's BYOB. And let's realize something on page 86 of the 5th edition. The infinite banking concept is a teaching organization
and is not affiliated with any life insurance organization, and in no way implies that a person will be guaranteed results comparable to anything shown in this book. No more than a school or professor at a school can guarantee a person financial success from taking a certain course of study or procedure. In fact, if the person obeys the principles outlined in the book, the performance can exceed the results that are depicted in these illustrations.
A lot of people get hung up on the numbers, and we're going to oblige and look at some of the numbers for you in this little short video. But of course, infinite banking is a concept. We're going to look at the definitions around infinite banking that are right here in the book to make sure you and I both stay on the same page about what is going on. Most people want to talk about investment returns. They want to talk about numbers only, and the concept eludes them, so they think it's about life insurance and making the numbers really pretty. That's why many people get thrown off by not getting the right type of contract in their life insurance portfolio to be able to do banking, because they forgot about banking and what it was. Okay, so let's look down here at the term finance, or finance, depending on where you're from. If it's Midwest, I think it's finance. So at the bottom of page 87, we see this: the system that includes the circulation of money, the granting of credit, and the making of investments, the provision of banking facilities. The verb of this, finance, I changed it up for you, to provide with necessary funds in order to achieve a desired end. And then Nelson puts his infamous definition about finance right past that. You finance everything you buy. You either pay interest to others or you give up interest that you could have earned elsewhere. It's very important to understand. Let's take a look at the word capital on page 87. I'm sorry, before that, we got to look at banking. Let's look at banking. The business of a bank, originally restricted to money exchanging and now devoted to taking money on deposit, subject to check or draft, loaning money and credit, and any other associated form of general dealing in money and credit. Now we'll look at capital. You guys with me still? Accumulated possessions calculated to bring in income, accumulated assets, resources, sources of strength, or advantages utilized to aid in accomplishing an end or furthering a pursuit. Okay, we'll stop right there for a second, just so we don't get hung up on too many words here. We've got to realize that when we're talking about the infinite banking concept and utilizing whole life insurance for that process, we are talking about a banking system, a system on which your money resides. So you've got the capitalization, which we'll get into in just one second, the money, the pool of funds to be able to deploy for whatever desire you have. And if that desire happens to be investments, great. That desire might be just paying off debt or paying taxes. It might be financing cars, as we might say so often in this world, to try to prove the point that life insurance built the proper way can definitely help you. But if we're not going to start at the foundational tools of the words and what they mean and what we're trying to help you understand in the concept, you'll go straight to investment returns. Does everybody understand so far? I doubt it, but let's look at some numbers here to make sure you understand. Okay, I've got right here an illustration for you. And then we'll go back to some definitions. Let's look at some numbers just to make sure we appease you here. In the top right corner, top left corner, you can see that this is a real person that we're working with right now, considering this type of contract. We've got a male, age 35. His initial death benefit is $2 million, as he's putting in $65,000 per annum with An exchange, a 1035 exchange, is a non-taxable transfer from one guaranteed product in the life insurance world to another guaranteed product. So he has got an old contract that he doesn't want anymore. And by old, I mean it's within 2 or 3 or 4 years, but he realizes it's not properly structured or built the way he would like to be able to deploy a banking system from. So we're going to take the value, the surrender value of that contract, and we're going to roll it over, if you like that term, into this contract. Okay, so now let's go to capitalization. Capitalization period, the time required to actually create a pool of money with which to start your own banking system. It definitely is not something that you can do overnight. You might have all the necessary capital or money, but there is still the element of time. It is like the process of getting a college degree. You may have the necessary funds on hand to pay for the degree, but you still have to go through the curriculum. Building your personal banking system through the medium of a dividend-paying whole life insurance contract will take as little as 1.5 years, but you still need to continue the capitalization phase for as much as a term of 10 years or so. The longer the period, the more strength of your system. Okay, you guys understand. What we're going to do is we're going to put money inside this life insurance contract with a mutual organization that's going to pay dividends. That's what we're going to see here. And the illustrative tabular details are going to help us to understand what's guaranteed and what might happen because of dividend profits in the future. We'll read about dividends in a second. So when we take a look at this contract, we realize that at the beginning, we are building a banking system. Most people will just throw away those terms without thinking about them. We need to capitalize or build the banking system so then this guy can deploy money for his use, but he can control the system. He can control the flow of capital in and out of his life by utilizing the facilitation of the life insurance company as his third-party dealer. Okay, so that's what we're going to take a look at. Let's go back into the numbers. We can see here that in year one, his annual premium plus the 1035 exchange amount totals $73,300. We can see that it's guaranteed to buy death benefit. Everybody with me so far? He will have a guaranteed contract from day one that's going to allow for protection for his family. This is life insurance. It's very simple there, and we all knew that before we got on this video. What we're going to do is we're going to pull the lever on purpose. So some of his premium that he's putting into, as we say, cup one, the red cup, is going to buy death benefit, of course, but also give us access to cash value. In this particular company's illustration, we can see cash values in 2 separate columns. Cash value on the lefter side, and on the rightmost side, PUA cash value. Everybody take a look there. So now let's go to the definition of what cash value is. I'm not going to get into your opinion or my opinion. I'm going to look at the definition. What is cash value? Page 87 again. The cash value on any policy anniversary to which premiums have been paid is the then present value of future benefits provided by the policy. Let's stop right there. What we have in cash value is the net equity, the today amount of the future benefit. That means it's been paid up, paid off, or paid for. What we have here is a pool that can be liquidated of the future death benefit the insurance company owes you, in this case, $2,017,000. And day one, if we take a 0 and we take a 45,775, we have a total of 45,775 total surrender dollars that can be borrowed against, turned into cash, and sent straight to this client for use. We have now a banking system that has that amount of money that can be deployed for whatever this guy's goals are. He does have some debts. He is in business. He's looking forward to some real estate transactions, but he also wants to pay off the pool, he told me, in the backyard, and maybe pay off the truck, the work truck. So in this particular example here, what you are seeing and what I'm seeing is actually the guaranteed cash value from the base premium, and the guaranteed cash value from the PUA. Let's take a look over here in cup number 1. Column 1 here of the numbers, the contract premium, shows us actually the base amount, and the paid up additions would be the rest. Paid up additions, and that is structured on purpose from a company that allows that type of structure, and of course we're specialists in doing it this way, to allow for there to be cash value early on. If we're looking at just what the base builds in cash value, we looked at the leftmost cash value column here. The base builds really well in terms of liquid cash value, but it builds slow. The PUA builds really well, and it builds fast and less efficient over time. That's going to be in the righter column here. So if you combine these two columns together, what this potential client has on his hands is the amount of total guaranteed dollars that can be borrowed against his death benefit and his policy for the use of financing. Now we have a separate pool of money to use, lose, or abuse for the use of whatever it is you want to do. Banking, finance, borrowing, lending, buying groceries, whatever it is. That's what we're here to talk about. Now, on the righter side of this illustration, what we're going to take a look at is the non-guaranteed elements. Let me point that out for you, and let's take a look again. As we look over here on the righter side, we have non-guaranteed, and you can see that dividends are purchasing paid up additions. Okay, paid up additions is the liquid equity now, the net now of the total death benefit. And if you look at the rightmost side, on the non-guaranteed side, what you're going to see is both columns added together, first off, and you're going to see if dividends are projected as is in the current dividend scales of this company, you're going to see on the righter side, you're going to see how much total equity is available on this policy moving forward in the future. So if this company continues to do that, we can be pretty confident we can look at this rightmost side. And these are the numbers this man may be able to deploy just based on what the company performance is and not the banking that he plans to do. Of course, if he likes to do banking and decides to deploy capital and then recapture that capital back into his own system by paying back his loans with interest, that's what we mean by recapturing, keeping those dollars within his system, these dollars are going to be too small. Ladies and gentlemen, too small, and he'll have a lot more money to use than just this. Now, we're going to go back to the book, and we're going to look at the definition here of dividends. Page 87. The earnings of a life insurance policy based on the company's mortality expense and investment experience during the year. When dividends are used to buy additional paid-up insurance at no cost to the owner, the cash value of the additions becomes guaranteed at that time. This value will increase with time but cannot decrease. And that's why we see dividends purchasing paid up additions in our illustration. We see that on the right side, we've got higher numbers than the cumulative numbers here each and every year with these two columns. Dividends are purchasing more paid up additions, and we can utilize those dollars, borrow against the policy of an ever-increasing death benefit to be able to deploy for our own personal banking system. So, ladies and gentlemen, it's not about the numbers. If you don't understand what's going on, you won't understand the numbers. Your number may not be $65,000 of premium per year with a base of $26,000. It may not be that at all. But building a banking system will allow you to be able to deploy capital against a guaranteed growing income tax-free life insurance contract for whatever it is you want to do. So if that starts to make sense to you, you will be able to translate these numbers into whatever type of premium that makes sense for you. My numbers are not his numbers. Your age is not his age. The death benefits will be different, but building a banking system is going to be based on a chassis of guaranteed whole life insurance, guaranteed growth in the equity of that life insurance contract, the equity of the death benefit guaranteed to your family and friends, and of course, the liquidity and the control of being able to use it without any taxes. So that's what we're talking about. Get back into the book. Call us for a free cash consultation about doing this process yourself and walking through your own numbers once you understand what the definitions are all about.
Gave a lot of game, we never got a lot of things. Bow your head and say the prayer. We taught you how to be the bank.